All right, good evening, guys, and welcome to lecture number 3 of our paper 2.1 ICAG class. In our lecture 2, we talked about PPE, and we were actually dealing with the tangible non-current assets, for which IAS 16 is part, IAS 20 is part, IAS 23, and IAS 40 is concerned. We want to move on to deal with IAS 23 and later do IAS 20 and IAS 40. But before that, just a reminder of what we did on lecture 2. Let's pick up a question and try to solve it. Then we will move to today's topics. So quickly, let me share the question up. Then we look at it. Now we have question 1 here. And question 1 reads, on October 2015, VVD acquired a machine under the following terms. So we have the manufacturing base price, we have discount, which is trade discount and is to be applied on the base price only. We have cash discounts payable on the base cost only. We have freight charges, we have electrical installation cost, we have staff training in the use of the machine, pre-production testing, purchase of 3-year maintenance contract. We have the estimated residual values of the assets given below. We have the machine life of the asset. And the story continued to say that on October 2017, VVD decided to upgrade the machine by adding a new part costing 200,000 to it. The upgrade will lead to a reduction in production time per unit of the goods being produced using the machine. The upgrade also increased the estimated useful life of the machine at October 1 to 4,500 hours, and its estimated residual value now revised to 40,000. We are asked to prepare the extract of the P&L and the SOFP for the machine at the year ended 30th September 2018. So it means that we have probably we may have 2015 into 16, 16 into 17, and 17 into 18. All right, so that is what we have. Now, what we've done, if you remember what we actually went through last lecture, you realize that we discussed the components of cost. Now, in the components of cost, if you remember, we actually talked about the cost being the purchase price, but indeed you have to take off discounts and any refundable taxes. And the discount we meant here, you remember, we said it's the trade discount. All right. Then we also talk about other direct costs incurred in bringing the asset into its condition of being used. And we talked about PV of dismantling cost. All right. Okay, so we take a look at this question. We need to fish out these things out of here. So we have the manufacturing base price here, and we have a discount. This is the trade discount. This is the cash discount. Remember this and this part is very, very important. The base cost, never said base price, but base cost. All right, then we have free charges. electrical installation, staff training, pre-production, on all these things. So our main job is to try and pick out and find out the cost of the asset, because if you remember, we talked about initial and subsequent valuation. And if you remember, we actually discussed concepts like depreciation and revaluation. Now, another word for the revaluation you could see here is what we call fair value, right? It's what we call fair value. All right. Okay, so that is what happens. And remember, we also talked about subsequent expenditure, which can be of capital nature, for which has the name and upgrade in this question. Okay, so that is that. So we need to pick out of these things what form our cost as at this date. All right, so that we will be able to determine our depreciation. Remember, the fact that the company starts in October means that it will be from October 1 year to September in the other year. All right, you need to know that. Okay, so that is that. So quickly, take a look at the question as you see here, as I pull up the board for us to talk about it. All right. Okay. So in terms of trying to deal with the question, what we are going to do is to try and determine the cost. So we take question VVD and we try to determine cost. Now you could see that from the question, we have a base price. We had a base price of 1,050,000. Then, like we said, you have to less, of course, the trade discount. Remember, the trade discount was 20% to be applied on the base price only. So we take this, let's punch our calculator. So we have 20% multiplied by 1050. So that is giving us something in the space of 210,000. And of course, we need to less it and giving us 840,000. This now is what we call the base cost. All right, we need to go on and add the other direct expenses, and you could see we have freight, which was 30,000. We had electrical installation, which was 28,000. And what else did we have? Let's go back and check. Okay, so we've actually dealt with the base price, we've captured the trade discount. This is always a P&L item to other income. It doesn't form part of the cost of the asset. Remember, we've taken care of freight, installation. What about staff training? From our previous lecture, we realized that this was also to a P&L item. Okay. What about pre-production testing? Remember, we said that every direct cost incurred in bringing the asset into the state of use as intended by management. So if you are pre-testing the thing, then it means that it hasn't gotten to its state yet. You are using the pre-testing production experience to get it to its useful state as you intended to use it. So therefore, this one will also be capitalized. All right, so we will pick this figure. Purchase of 3-year maintenance contract. These are repairs and maintenance. Remember, it's a P&L item. So let's go back and complete our cost structure. So we have pre-production testing to be 22,000. In the end, what do we have? Let's punch it. Yeah, 840, 30,000, 28,000, and 22,000, giving us our cost to be 920,000. All right, so this becomes our cost of machinery. All right, so this becomes the cost, and this cost determination is as at October 2015. All right, the question now goes on to tell us that there was an upgrade that was done in 2017. Let's look at it in 2017. But remember, so up to from 1st October 2015 to September 2016, we have the total useful life. We have some residual value. We have this estimated useful life as at each point to help us determine the depreciation. Remember, if we are now going to go into October 2017, then it means that we need to actually capture our depreciation. All right, we need to capture our depreciation. So what do we do from here? We need to now bring in the cost of the asset and depreciate it so that we can actually go on with any other form of upgrade determination, any revaluation, whatever we want to do, we can actually have it there. But if we want to look at what is going to happen in terms of our depreciation, then now that we have the cost of the asset as at this time, we can actually determine the depreciation. Remember, in our quest to determine the depreciation, you need to take note. These are the timings, and these are the machine hours. The total estimated is here. So if you want 2016, you have to take 1,002 divided by 6,000. All right, for you to get the same here, you have to take 1,008 divided by 6,000. Unless I think the last year there was an upgrade in 2017, so we may have to check in terms of what we are multiplying these figures with. Okay, it's very important. So if you look at the question, you realize that the upgrade increased the estimated useful life on. All right, so you need to take note of that. So what is going to happen is that we need to calculate our depreciation once we have this cost for the year. So depreciation for 2016 September has to come by we taking our cost, which is 920,000. Remember, there's a scrap 20,000. All right, and we need to now go through and multiply this by 1,002 all over 6,000 machine hours. All right. What is this going to give us? You're going to punch in your calculator. You see that this one ends up with an annual depreciation for 2016 being 180,000. All right, so that is the part in terms of dealing with the first year. Now the question went on to tell us that there was an upgrade of this machine in 2017. In 2017. We need to now look at the timing of the upgrade, as in when it was done in 2017. So let's go back and find out when the upgrade was actually conducted. Okay, so we've done the depreciation for 2015 to 2016. The upgrade was done on 1st October 2017. What does this tell us? It means we need to go through and do another depreciation, okay, for 2016 up to 2017 September before we can actually come out when doing the upgrade on 1st October 2017. Okay, so let's now go back and try to push our depreciation in. So we need to now do another depreciation. Remember our machine hours. So we need to go through and do our depreciation for 2017 September. We have the same cost, 920. We take out our scrap, 20,000, and we multiply by the number. At 2017, we had 1,800 divided by 6,000, and that is going to give us 270 cedis. All right. So if the upgrade is now done on October 1, 2017, which is the last year, we now need to come back and say we had an original cost that was 920,000. We now need to less accumulated depreciation, and our accumulated depreciation will now be 180,000 plus 270,000, which is giving us 450,000 to give us a carrying amount of 470,000. Now, what is going to happen is that they upgraded this on October 1, 2017, with an amount of 200,000. So giving us a new valuation of 670,000. This now becomes the cost. If we now need to determine the depreciation of the assets in this current year, the story went off to tell us that the scrap value, which was 20,000, was 10 to 40,000, and the useful life was changed. So we now need to do our depreciation for September 2018, and that will be equal to, we having the new price 670. We take off the scrap, the new scrap, which is 40,000, and we now need to multiply it by 850. That was there with a new change of estimated useful life of 4,500, and that one ends at Need to punch your calculator. Then we are having 119,000. So this now forms our depreciation for the specific year. If we now need to go through and prepare our P&L extract, we will have something like our P&L and SOFP extract will now be looking like this. We divide the page. Let's look at our P&L extract for the respective years. So we have 2016, 2017, and 2018. Likewise, we have the statement of financial position. We have 2016, 2017, and 2018. What is going to happen here is that at the end of the year, we have depreciation. For the respective years we calculated, we have 180,000 here, right? We have 270,000 here. Then we have 119,000. Remember, they did a maintenance contract, which at 60,000 for the 3 years, splitting it equally. You now have additional. These ones are expenses that are showing up in your P&L. Let's keep them in bracket. You have your 20,000, 20,000, and 20,000. Another thing that we don't also capitalize was the staff training, which is also an expense. Our staff training was for this year only, so we had 40,000. So that is that for, but we should not forget that we have a discount received. All right, discount received, you remember, it was 5% on the base cost. What was our base cost? It was 1,050 minus our discount, trade discount. We now need to go back and check what we've done in our working so far. Okay. So what was it we were having there? So this is it we are having here, 840. Then we now need to go back and apply the percentage. So we now need to come back. And our discount received has to be 5% multiplied by the 840,000, which is a P&L item. So all these are expenses. We need to drop them in a bracket. Then we have, so 5% on this gives us 42,000, which is an income. So we leave it 4P. Okay, so we therefore close these sides of the account. And what do we have here? 139,000. We have 290,000, which are expenses. Then we have here 198,000. Now we come to our statement of financial position. Remember, it shows a carrying amount. So in terms of carrying workings here, we actually had the cost of the asset in this year to be 920,000. 920,000, but an upgrade happened here, making us have 670,000. Remember, we had to less accumulated depreciation, and it accumulates. Okay, so once you have your 180,000, you had additional 270 to make this side accumulated to 450. And when we changed everything, we had a new depreciation, yeah, of 919,000 after the upgrade, because the machine had taken a new figure and it had taken on a new depreciation. Okay, so we close it. We have our carrying amount. And here we have 740,000. We have 470,000 and 551,000. Most important bit is that you need to expense those items that are of revenue in nature, okay, and capitalize those ones that are of capital expenditure in nature. E.g. here was the upgrade that happened to the asset, okay. Okay. So we now come to what we want to do today, and we want to tackle IAS 23, borrowing cost. Borrowing cost. Now, like I always do, we are going to look at the definition. We are going to look at recognition. And especially under this borrowing cost, we are going to consider some concepts. Recognition. Here, in terms of recognition, we are going to consider commencement of capitalization. And we will be looking at something like suspension of capitalization. We will now go on and talk about cessation of capitalization. Okay, then in terms of the measurement, we will be looking at the capitalization rate. Okay. Now, what is borrowing cost? When we talk about borrowing cost, we are trying to understand that the cost you incur in borrowing funds for a qualifying asset form part of the cost of the asset. Essentially, what the standard defines as borrowing cost is that it is a cost, the cost of loan, or herein, let's say interest and other costs incurred in borrowing funds to construct a qualifying asset. What then do we call a qualifying asset? Qualifying asset, according to the standard, is an asset that takes substantial time or necessarily takes substantial period to get ready for its intended use or for sale. All right, so any asset that you have to borrow for, and it will take necessarily a substantial time for you to get it ready for its intended purpose is what we call a qualifying asset. The definition for a substantial time is not actually defined in the standard, but we mean at least it should take you some time to get it done. All right, let's look at the recognition criteria. The standard gives three conditions that should happen before you begin to capitalize the borrowing cost. Number one, the standard says that the expenditure on the assets, here the qualifying asset, is incurred. So when the expenditure on the qualifying asset is incurred or being incurred, all right, is being incurred. That is one. The second condition is that the borrowing cost itself, the borrowing cost is also being incurred. All right, the third bit is that work has commenced. Work has commenced. Or we say that activities necessary to prepare the assets for its intended purpose or sale are in progress. Okay, all right, and these three things must happen before you can start capitalizing a borrowing cost. All right, importantly, you should take note of that. It is very, 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 very. Now, what we should know here is that there comes a point where you will have to suspend the borrowing cost. You suspend the borrowing cost if there is any kind of stoppage, all right? If there is any kind of period where you have to pause on the construction that you are doing. If the basis for you stopping is not actually part of the technical process of the construction, and then it means that you need to also stop capitalization costs. I try to make this thing so easier for students. Okay, so I say that if the stop, whatever made you stop is purposeful. And what I mean by purposeful means that it's part of the process of getting the asset ready. Then you don't stop. You don't stop borrowing cost. You don't stop borrowing cost. However, if the stop is not purposeful, sometimes people go on strike and disputes result in people going off for a while. Then it means that it has nothing to do with the building. It's just about the people. All right. In that case, you need to stop. You need to stop capitalization of borrowing cost. All right. So if the stop is purposeful, then you don't stop. But if the stop is not purposeful, then you have to stop borrowing cost capitalization. All right. Now, the standard book force to indicate us that we get to a point where we need to cease capitalization of borrowing cost, of which this part is an example. We cease capitalization also when substantial part of the activities necessary to prepare the qualifying assets, for its use or sale are complete. All right. So it is not when everything is complete, but when substantial part of it is complete. All right. You need to take note of that. Okay. Okay. So that said, let's now go on and talk about the capitalization rate. Let me create a new place. All right. The capitalization rate. Okay, under this, we are going to make it a specific rate where you take your borrowing cost and you less any investment income from investing that same money you borrow. All right, so if you temporarily invest the money that you borrowed, and then that one means that you will have to deduct it from the borrowing cost. A typical example is this. So let's say Ama took a loan of 10 million cedis at a rate of 6%, 6% on, say, January 1, 2011. The purpose was to build a house or for the purpose of our discussion, a landed property, let's say an office. Okay. Now, if you go on to tell us that not all the funds where immediately required. Of course, a building is in processes. And so she invested say 2 million in bonds, deriving him 3%. These bonds are 3%. So say 30th June 2011. Our question goes on to tell us that the construction of the office began on February 1, 2011, and was completed on say 31st December 2011. Now, if we now want to find out the amount of borrowing cost we need to capitalize, then is the specific rate we are talking about here. We now need to go on and find borrowing cost by doing, and remember, every time you see percentages for interest, they are always stated in per annum basis. And therefore, you need to make sure that you are applying the specific timing to the money. All right. So if you borrow on January 1, and it's something that is going to, or a project that is going to last for December, then what is going to happen is that you need to get your borrowing cost herein will be the interest of 6% multiplied by 10 million. Remember, the timing of borrowing to the time of this has to always be checked, okay? It has to always be checked. Now, this one will mean that we will have 600,000 cedis, okay? 600,000 cedis. Now, like I said, we need to really check the timing of what we are doing. If you check the question, it said construction began on 1st February, all right? So 1st February. So in terms of trying to identify this, we need to now go back to the recognition criteria to deal with, all right? Number one, we said the expenditure has been incurred. It's being incurred. Number two, borrowing cost is being incurred. Number three, activities has commenced. Now, when was the activity commenced? You see, this is where the activity commenced. So our counting of timing must actually start from February to 31st December, which is 11 months. So what is going to happen? What is going to happen is that we need to now do 11 months of this interest, for which we are going to get 550,000. What is going to happen here is that we now need to come and also less the income that we get on investment, which is going to, for us, be here. We have 2 million cedis, and the rate is 3%. Again, we now need to check the timing of the investment. They told us that the investment started from here and it ended in June. So we have 6 months for the 3% rate. If we do that, then when we less it off, we should have 550 here, and we should be deducting 30,000 from this. Confirm with calculator. So we have 2 million multiplied by 0.03 or multiplied by 6 over 12, which is 0.5. Indeed, we have 30,000. Which is going to tell us that we now need to capitalize only 520,000 as part of our borrowing cost. What is going to happen here? The extra 50,000 that we are not capitalizing for the month of January will now go to P&L. So 600,000 was it? We to recapitalize 550. 550,000 at this instance. As we saw here, we are now going to treat the 50,000 to P&L as finance cost. That is the 1/12 out of the 600. So 600,000 that we have. All right, that is it. That is it. Now you realize that even with this 30,000 that we had, that is commencing from January, we now need to also factor in the 1 month that is not being considered at the borrowing cost level. Okay, so we now need to come back here. So in terms of this one, we should have. So we now need to take off this for the mean. We should take the 5,000 for the January one that is not considered as part of the borrowing cost concept, which should land us with 25,000. And therefore, this figure should actually be 5,200, 525,000 herein. All right, so you scratch this. This 5,000 will also now be represented as an income that came in January. All right, also going to your P&L. Please, the timing is very, very important. You need to check the timing. It's very, very, very important. All right. So that said, let's go back and talk about the other general rates where we have to apply weighted average, because this is very, very important. The timing is very, very important. All right. So now let's go back. And talk about the general borrowings. If done with specific borrowings, let's talk about general borrowings. Now, for general borrowings, that one will mean that we need to apply the weighted average cost of capitalization. Weighted average cost of capitalization. That one is the work for us here. So what we are going to do is to take each loan and weight it. All right. Then after getting the rate, we now apply it on the amount of the loan. So for example, if an entity wants a 10 million 6% loan and a 2 million 8% loan, what is going to happen is that we now need to weight them. How do we do that? We now need to take the 6% multiplied by the 10 million, all right? And we will now divide everything by the combination of 10 million plus 2 million. 10 million plus 2 million. All right, we do the same here where we are going to do 8% multiplied by 2 million all over the combination here. So all we are doing here is to weight them. And this It's going to give us how much? Punching the calculator. Okay, we are having 6.33% per annum. This will be our rate. If we're now going to apply this rate to the cost, then we need to come back and do it as per the specific, all right, rate, where we have to check the number of months the percentage is going to be used for, which is very, very important. Okay, now let's go up and take some questions and try to practice what we have learned on the borrowing course. Okay, so there is an illustration for us to look at. All right, so it tells us that Akrofi has the following at the beginning and end of its account. This is what we have. Then we have 10% bank loan repayment, 2018. These are what we have. We have 9%, we have 8.9%. And they continue to tell us that the 8.9 debenture was used to fund the construction of a qualifying asset, a piece of land, on July 2016. On January 2016, I said that Kofi began the construction of a qualifying asset of a piece of land, a piece of machinery for hydrochloric plant. Using existing borrowings. Expenditure drawn down for the construction were 30,000 on January and 20 on October. If the accounting year ends in December, then it means that we need to actually check the prorating of this. All right. So you have the solution there. So what do you do? What you are going to do, because it is a general borrowing for that aspect. Like you do, you take the 10 we just did, multiply, average it, you get your 9.89. All that you do is to take your 9.89. If this one started from January, then it started all 12 months. Okay, you are good to go. This one is from October. Then you now need to count October, November, December. And when you are multiplying, you need to use 3 months and wait. Okay, that one gives us. It's so simple and short. Let's look at a question. There is a question here we need to go through. What does this one tell us? This one is telling us that Mr. Ansar Limited decided to construct a new property on this day. Consequently, he said the following took place. I think we need to correct this thing, make it 2021. All right. So he bought an asset on this day and deferred the payment to this day. Contact and correspondence to secure the building permit took place on this day. The building permit was secured on this day. The loan for the payment of the land and for the construction of the asset was obtained on this day. Because of heavy rains, he said, experienced in March and early part of April, the actual construction could not start until 16. When should borrowing costs commence? Remember, we said that cost has to be incurred, borrowing cost has to be incurred, and activities should start. All right. So where do we see? You see all these things borrowing, the loan is taken, expenditure, the borrowing cost is incurred here. All these things are trying to tell us that the activities are in place. Okay, but we could not commence borrowing costs because of heavy rain. So it impacted the rain. So if we are now going to look for the date to start the construction, then it's going to definitely, because that is the last day, everything. Actually, you have this date for completion of everything, as you can see here. However, there was a suspension that was done. Activities weren't started. So the last part of the recognition criteria had to wait to this day. All right. So that is when we could capitalize borrowing cost. All right. So that is it. We need to really go and find our way around it. Probably we should take another question. If we are going to go through question 2, then what we will find is that if our commence construction of an item of property, plant and equipment on this date, okay, then we need to make sure we take note of the date. And funded it with 10 million note. The interest is 5%. It said due to a strike, no construction took place on between October and November. We are supposed to go through and calculate the borrowing cost. What now is going to happen is that we just need to take our 5% and multiply it by our 10 million. The question is, how many months are we going to apply it for? The fact that there was a strike means that this is not purposeful for the contract. We need to now cease borrowing costs for this period, which is a month. When did they start? March. So March to December is 10 months, and we suspend 1 month out of it. Then that will mean we need to go through and multiply it by. So punching this on my calculator, it gives me 375,000. So this becomes the amount of borrowing cost that I should capitalize. So simple and okay. Let's, is there another question perhaps? Question 3. So Thompson had the following bank loan. So we have 2 loans. And Thompson commenced an item of property, plant, and equipment. Date is very important. This is the date. For which is used existing borrowings, and these are the existing borrowings. 1 million expenditure was used on January 1, and 50 million was used on July. We are supposed to go through and determine the borrowing cost. Now, what will happen is that this one is a general borrowing, and therefore we are going to go through and weight it. So we have our 4%, 25,000, 25 million. The joint gives us 65. Yeah. So going to be 65. You have to deal with this thing now. And we now need to go through and do 3% over 40 and 65. Now, when we go through this, where we are going to land is that gives me 3.38%. After obtaining this, it now serves as my specific rate, and I need to come and apply on the 1 million for this period and the 50 million for this. So what is going to happen is that I pick my 3.38% and I'll multiply it by 1 million, which went through from January to December. So I will leave it like that. Then the other angle, the same 3.38% multiplied by 15 million. That one started from July, so it's going to be 12 months for the period. What is going to give me at the end? These things are million, so I actually have say 0.59 million. All right, so that is what that ends me. It's very important that you do your weighting to get to the specific rate. Then when you are applying it, you need to check if there is any investment at this point. Then investment income has to be deducted. All right. Okay. So take note of that. Big goals. Let's look at if there's any other question. I think you need to take your time and go through question thumbs too. Let's look at question 5, which I find a bit interesting. All right. So question 5, and this one combines PPE and the standard we've done now. All right. So it says during September 2013, and data key, you need to underline. Sahara built a new mining facility to take advantage of the new laws regarding the onshore gas extraction. Construction of facility was 10 million. You need to take a note of this. And to fund the Sahara took a 10 million, okay, 6% loan note, which will not be repaid until 2016. 6% interest was paid. Okay, so there is an interest that has been actually paid on this date. Okay. All right, so we see that interest has been paid. Then it said that construction actually began on October 1, 2012, and the work was completed August. So normally if accounting year ends in September, then probably it began October in the previous year. All right, but we have August before September, right? So it means that there is a sort of 11 months thing here we need to take note of. All right, let's go on. As not all the funds were required immediately, so I invested 3 million of the loan. You remember investment for 4% bond, and they started from October to January. October, November, December, January. That one will give us 4 months. All right. The mining commenced on 1st October and is expected to continue for 10 years. All right. So that is noted. That is noted. Question goes on to tell us more. It says that as the condition of being allowed to construct the facility, Sahara is required by law to dismantle it. Okay, so we remember dismantling cost. All right, that is very important. Remember PV of dismantling cost in IAS 16. And Sahara estimated that this will cost him 3 million, all right, in 2023. Okay, so we will have to do some counting in the number of years to do our PV. Okay, where we got our cost of capital? All right, so there's a cost of capital here. I said that equipment is extremely specialized. I invested significant resources in recruiting and training employees. Sarah spent 600,000 in this process of that one is pure P&L item. Believing it to be worthwhile and anticipates that most employees remain on the project for the entire 10 years duration. Okay, so it means that even if you are going to spend the 600,000, probably is for 10 years. All right, so let's go ahead. I want to leave you to go through the question again, whilst we will open a new page to deal with. So you could see clearly that our requirement is to show the correct financial reporting treatment as at 30th September 2013. Herein, you see there are borrowing costs in there, there are PPE in there. Okay, so how do we approach this? Well, let's get to our board. Okay, so what do we see? I think we should start with our borrowing cost. What is the borrowing cost? They told us that capitalization will have to begin from October 1 to September 1 because of the August timing of completion. All right. Okay. All right. So we start from October and we end the thing in September. Okay, but in this question, as you can see, let's go back and see. Oh, so we actually, the August is the timing of the completion. All right, the August is the timing of completion. So we actually start here in October. That is when it becomes, and it's completed in August. All right. So we are actually going to end it on 31st August, not 1st September. So we need to go back. 30th, 1st August. We need to come back. But remember, they also invested the money for October, November, December, January. All right, so we need to take note of that. So what is going to happen here is that we need to now calculate our borrowing cost from what we have. So we say interest payable, which is the borrowing cost, determination. We had 6% multiplied by 10 million. So from October, November, December, January, February, March, April, May, June, July, August gives us 11 months. Right? So we need to know which is going to give us 550,000. Sure. All right. Now we now need to take off the interest that they earn. Interest earned for 4% on the 3 million for the 4 months. and that is going to give us 40,000. So the amount to capitalize herein is going to give us 510,000. Okay. Now, it must be noted, let's make a note here, that the capitalization was actually, we are doing this thing for September, and the question told us that interest was paid for. So if interest was paid for this whole period, okay, but the time the money was taken is actually within the 12 months, but interest is just the portion that we are capitalizing, that is 11 months. Then we need to now go on and do 1/12 of the 600,000, the part of it that we are not capitalizing, all right, which is 50,000 to our P&L. I think you saw this in our first example. All right, so that is that. All right. Probably the second thing we need to go through and do is to try and do the PV of our dismantling cost. We now need to do the PV. We have a cost of capital of 6%, and we now have to start and count from the October 2012 to the time that they are going to do the dismantling. Let's go back and check the timing. All right. So the construction is actually in 2012, and they told us that the mining commenced on 2013, and the dismantling is going to be on October 2023. All right, so the timing should actually be the time we began the construction and the time that we are going to take the assets off. So the range of time here, we are sitting and doing our PV in this year of our question, and that is in the year of October to September 2013. So what is going to happen here is that our timing is actually from October, excuse me, our timing here is actually from October 2012 to October 2022. Counting this, we have 12. So 12 into this will be 1 year. So then 12, 13, 14. So we have 13, 14, 15, 16, 17, 18, 19, 20, 21, and 20. That one gives us 11 years. 11 years. Take your time and count it well. We have 11 years. All right. So that one will mean that if we are going to PV dismantling cost, we are now going to go through and look at the money that we are spending, which is 3 million. We have 3 million, and we have 1 plus our cost of capital, which was 6%, 0.06, all raised to the power 11. Let's point this on calculator. And that gives me, we had 11 years, and that gives me 1,580,363 approximated. Remember, this is the smart cost. What is going to happen is that every year we need to unwind interest cost. So we have unwinding interest to our P&L, which is going to be our discount factor of 6%, multiplying this figure 1580,363. If we are going to continue the unwinding, then we are going to apply the 6% on this same amount plus the interest of what we will get here being 94,882. Okay, so this is the current unwinding. If we are going to unwind for another year, we now will have to combine this figure with this one before we apply our rate. You see that as we move on with that, at the end of the 11th year, the money will actually shoot back to the 3 million. All right. So that is the concept under it. So if we now need to now consider our PP, then we need to come here and say that our PP cost, we have construction cost, which is 10 million. We had our borrowing cost, which was 510,000. Then we have PV of dismantling cost, which is going to give us what we have here, 1580,363. Putting this together, we will now have 12,363. So that is the PV. This money will now have to be depreciated from the time the construction began with its useful life. And you can see that we have 10 years through the project's lifespan. And we now need to go through because commencement actually started in September. All right. Commencement of usage actually started in September 1. All right. So if we are now going to start with our depreciation for 2023 or 2013 September, we are now going to go through and do a year out of the 12 years, 12 months, and multiply by the figure we have here, which gives us 100,753. Okay, so you could see the timing of the commencement of the asset. Let me pull it up so that you can actually see what we are talking about. Okay, so the question went off to tell us that construction began on 1st October and ended here. So you could see that when it ended is the time that they actually started using the asset. And it is further expanded here that they started on 1st September 2013. So you will actually have 1st September to 30th September, giving you just 1 month of usage of the asset in that specific year. And that is why we had to do 1/12 to obtain our depreciation for the year. Okay. Key thing is that if we now want our carrying amount for that 2013, we now need to go through and do 12,090,363 and take off our depreciation, which is 100,753. And how much would that give us? We get 11,989,610. All right, so that is that. If we want to prepare an extract for what we have done here, then we need to go through We need to go through here and probably present our P&L here and bring our SOFP extracts. Yeah. So in terms of what is going to the P&L, we have depreciation, which we have 400,000. Don't forget there was a staff cost we had to incur of 600,000. Then remember unwinding finance cost gave us two components. Do you remember the interest that was paid? The 1 month out of the interest gave us the 1/12 of the 600,000 actually gave us 50,000. And the unwinding also gave us 94822. Putting them together, we will have to calculate and get our total. Remember, all these are expenses. Okay. So let's put them together. We have 100, 573, plus 600, 123, 50,000, plus 94822. All right, that one is going to end up giving us 845,575. All these are expenses. If we now have to come to our statement of, we will have our NCA, tangible NCA. We have PPE. The carrying amount we had was 11,960. The loan is a liability, so we have NCA, which is going to give us the loan that we borrowed at 10 million. And the PV of dismantling cost, which is a provision. Okay, this is a provision. And that we are going to go through, remember, do 1580363, which is a NCL. We can slot it in here straight, 1580363. And don't forget there's a current liability of provision of the unwinding for the one to come in the next. We have 94,822, right? The corresponding. Okay, so that is how. Remember, anytime you have to PV, you have to unwind something to your P&L, and also bring what you need to come to the current liabilities. All right. So that is that for borrowing cost. There are so many examples in the slide that I've been sharing with you. You need to go through and practice. All right. And that is the only way to go. That is the only way to go. Let's go on and complete the other non-current asset standards. And we want to look at grants. Let's look at grants. IAS 20. We are talking about government grants and disclosure of government assistance. Wow. Okay. Like we do, we are going to go through definition. And we are looking at grants. We need to understand government grants. When we talk about government grants, the key importance is that the government here refers to, the government or government agencies, all right, and similar bodies. So it can be international, it can be local, all right. So far as they take the shape of government. All right. Now, when it comes to government grants, we are talking about assistance. But this assistance that we are talking about is in the form of economic resources. That is the key. What we are trying to say is cash. All right. It's economic resources. All right. And that is given to an entity, not for free, but in return of past or future compliance of some operating condition. You need to actually, give something to obey something to get it done. That is why it's very difficult for us to understand that this Western world actually give Ghana grants in return. It makes it very difficult to understand. All right. Now, we now need to understand the second bit of it, which is government assistance. It is also an assistance. It's actually an action, not an economic resource. Okay, not an economic resource. It's an action designed to provide economic benefits. To a specific entity or range of entities. Qualifying under a certain criteria. Right? All right, so that is how this one, especially when they give you a local license to operate somewhere. All right, so that is the grant that we are talking about. That is that. Now, what you are supposed to know is that grants takes form of revenue grants and capital grants. So in terms of talking about grants, we have revenue grants, and we have capital grants. All right. Now, in terms of talking about revenue grants, it's kind of those ones that are given concerning P&L items, and normally probably a government contribution towards the cost of wage, all right, contributing to the cost of wage, all right, and it is revenue in nature, okay, and so therefore, you will present it in your P&L, okay, presented in your P&L, all right, presented in your P&L. These ones are of capital nature, so they are given in respect of capital expenditure. We call it CapEx. Example, to purchase a machine. All right, and it is an asset grant. Okay, it is an asset grant. And what you need to go through and understand is that for revenue grant, you have two ways of treating it. You can present the entire grant amount that has been given you in the other income. So you can present grant as other income in your P&L, or you can actually deduct it from the related or specific expense of which the government gave you the grant. All right. We will look at some figures to it. Okay. So that is how it is treated. When it comes to the capital grant, that one too similar. You can write it off against the assets. Okay, or you can also defer it. You can actually defer it as a credit, and you will be transferring portions. All right, every year to offset the depreciation in the P&L. Okay, so let's look at some figures in terms of the numbers and how you are going to treat it. Okay. In terms of the revenue grant, okay, so what we mean is that if the government give you like a grant for, let's say, 2 million cedis for an expenditure that you are going to incur for 5 million, you have to have method one of saying that, okay, so I'll present the 2 million in my other income, a positive figure of 2 million, and I'll go ahead and treat the entire 5 million as an expense, right? So like this, that is how you do it. The second method is simply saying that, oh, if you actually record what you incur, all right? So what you are going to do is that you are going to show 5 million, you less your 2 million, and what will be presented in your expenses is just 3 million. All right, in technical sense, it's the same. So that is how. Now, what about the capital aspect in nature? Or say what we are going to say is that if you are going to buy an asset and the asset is say 10 million, for useful life of say 10 years, and the government also give you a grant out of this to be say 5 million. What the treatment here is saying is that for method one, you are going to offset it. Offsetting, what you're going to do is that you're actually going to say the cost of the asset is actually straight away 10 million minus 5 million. All right, which in sense means that what is going to happen is that the depreciation that is going to show up in your P&L will now be the 5 million all over the 10 years of the asset. All right, and that will give you uh, 5 million, 10 years is going to actually give you 500,000. All right, so that is what will be showing in your P&L. If you now have this, you take off your, you actually take off your P&L for that particular thing. Then it means that you are going to have your 5 million unless your depreciation to have your carrying amount presented at 4.5 million. Okay, that is how it is. Now, if you are going to go through and use method two, what is going to happen is that you are going to maintain the cost of the asset to be the 10 million, meaning that depreciation each year is going to be 10 million over 10 years, and is going to give you 1 million. So you are now going to go on and defer the grant of 5 million. All right. How are you going to approach that? So what you are going to do is to also amortize the grant, which is 5 million all over the 10 years, which is going to give you 0.5 million. In that case, what you are now going to present in your P&L will now show depreciation of 1 million, and you have other income also amortized, all right, being your grant amortized, being 0. In the sense, what you are going to show is that you see 500,000, you less this, the net is also 500,000. In your SOFP, so what is going to happen is that indeed in your SOFP, you have the machine which costs 10 million. So your CA will actually be 10 million. You now need to go on and less your depreciation of 1 million and present your 9 million. Here you now have some NCL, which will be those ones that will be in the long term of your grant, and some CL. So the next year's amount to be released into the P&L is the CL, for which every year is 500,000. Yeah, so 500. Also the zeros up there, 500. If you now add this 500 to what you have released, you are left with 4 million in your NCL. So that is how the presentation is going to be in terms of your deferred. Remember, these ones are now monies for you. They are income instead of liabilities. All right. So you take note of that. So that is how the presentation is. Okay. So it's so simple as that. So simple as that. Now, what you need to know under grants is about reversal. All right, reversal of grants. You need to go ahead. If the conditions that is supposed to be met for the grant to be obtained is not fulfilled, then it means that you need to reverse the grant. All right, you need to reverse the grant. And what you are going to go through to do is that if it is brief, all right, and you have to also you use this method, okay. If you use this method, then it means that if you are going to release everything, let's say the 10 million back, then if you are going to, you have to release all the 10 million, then it means that, or the 5 million grant, sorry, the 5 million grant, then you need to start the crediting from this side, all right? Any balance that remains goes directly to a P&L, okay? So these ones are debits. If you are reversing, you need to credit this side, okay? All right, so that is that. But if you use the net off method, this method, that we are talking about. It means that what you are going to go through and do is that the cost of the asset has to be increased again, because remember, you reduced it. You have to now debit the asset again with the reversal that you are going to make. All right, because you see, you credited the asset with 5 million. Now you have to increase the cost of the asset again first. All right. Are you getting it? As if the grant never existed. All right. The corresponding entry will now be a liability. All right. That will be set up for the payment of the grant. So you debit the asset, you credit liability. All right. So that is it. If this method is used, you debit asset. Okay. Then you credit, you set up a liability. All right, you set up a liability so that when you are paying the money actually to the government, you will now have to go on and debit this liability. All right, you debit this liability and you will credit your cash. All right, for the reversal. All right, if you use this method, what we are saying is that if the deferred method is used, then it means that whatever remaining grants that will be paid, the amount has to be released into the P&L on the reversal. All right. So if we can now come here and reverse this amount. All right. You will now come here, you do the reversal. You now have to be debiting this account. You debit this account. The corresponding entry, if you are paying directly, has to be on your cash book, all right, on your cash book. Okay. So as if the grant never existed, you are going to come here and actually credit this. Remember, here you did not touch your assets. Okay, you actually bought it at that same level. You did not touch your asset. All right, so that is why in the deferred method is used, the remaining grant has to be repaid to the government, or because it is already seated here in liability. You don't need to create any liability. All right, so you go ahead, and what you're going to do is that these things are already seated here in debit. They are not a liability. They are actually seated here in debit. So you have to credit this account. All right. You have to credit this account and now do the reversals that you have done in terms of the depreciation debit. All right. You debit it off. Okay. So if you now pay the money, then it means that you are paying it directly into your expenditures. All right. So if you bought the asset, it will now be something within your cash and the asset directly. That is what will be standing there. Please take note of that. It is very, very, very important. Okay, so that is it for grant. Let's quickly go on to the last standard under tangible non-current assets and end the class for this side. Okay. So the last standard we want to look at under this is IAS 40. IAS 40. IAS 40. Investment property. Here we are going to look at definition. We will look also at recognition. And we will talk about measure. And after measurement, the last thing we will look at is transfers. All right. This is one of the easy standards. It's so quick. So we take it quickly. What is an IP? An IP is a property. It's a property whose value is gained through rental or appreciation, or let me put it in this way, like they are assets, properties that are held to earn rental income or for capital appreciation. Or for capital appreciation. A typical example is land that you hold for. So a land held for capital appreciation, a nice business, of course. All right, and a building that you give on operating lease. All right, now what are the recognition criteria? It's an asset, so probable future inflow of economic benefits, all right, to the entity. Number two, we are talking about reliable measurement of cost. All right. Now, when it comes to the measurements, we have initial measurements, and we have the subsequent. Okay. Now, the initial measurement is at cost, of course. Initial measurement is at cost. Is and by this time, if I say cost, then you know what I'm talking about. All right, the purchase price and less discounts and all those things. You know what I'm talking about. All right, that is that. Also at an ROU, right of use, if it is a lease. All right. IFRS 16 applies. All right. So you take note of that. Now, what you need to go on and know is also the subsequent measurements. As for the initial measurement, whichever one you pick is what you do by consistently. All right. So that is. What about the subsequent measurement? Subsequent measurement, we have two. We have the cost model again, and we have the fair value model. The fair value model. All right. What you need to know about the cost model is that it's just the way you treat it under IAS 16. Okay. So you have, what you will have here is the cost of the asset. Then you will less accumulate. All right, then you land at your CA. Now, if there is any further revaluation, we all know that the revaluation surplus will go to OCI, and revaluation loss will be to the P&L. All right, okay, so that is that. Under the fair value model, what is going to happen here? So you see here, you have this is either this one is going to SOFP or this one, and if there is any depreciation, which will go to P&L. All right, so that is what you see under the cost model. Under the fair value model, the fair value will go to the SOFP, and any revaluation surplus will go to the P&L. All right, unless there is an initial revaluation that has taken place. One key bit you need to know here is that once you go by the fair value model, you do not depreciate the asset. All right, no depreciation. Take note of this because this is where it gets tricky. All right, no depreciation under the fair value model. All right, no depreciation under the fair value model. What I'm going to do here is that if you have a PPE and you are transferring it to an IP, you need to revalue the assets. And what you're going to do is that you will treat the revaluation surplus to OCI at the date of transfer. Date of transfer. All right, that is very, very important. If you have an IP, and you are transferring it to a PPE, it has to be at fair value. All right, IP to PPE has to be at fair value at date of transfer. What is going to happen here is that if it was a IP, then it means if it is at fair value, then it means it will never be depreciated unless it takes the status of a PPE. Then you will have a depreciation. So, let's deal with one under IAS 40, and we can bring the class to an end. Okay, so let's look at this question. and see how we are going to go through it. Okay, so we said that Divo Corrigi owns a property in which is using as its head office on January 1, 2015. Its carrying amount was 20 million and its remaining useful life was 20 years. On July 2015, the business was recognized, they recognized a cheaper, in the keyword, yeah, it's a cheaper premise were found for use as its head office. They therefore decided to lease the property under operating lease, and the property was valued by a qualified professional who valued it to be 21 on this date, July 21st, and another valuation of 21.6 on this date. Okay, so what is going to happen here is that since they were using the property from this date up to the date they decide to change its status here, it is actually a PPE. So IAS 16 will apply. All right. So what is going to happen here is that it's a 6-month thing. We all know that if the thing was 20 million and useful life is 20 years, then we now need to go through and strike half of the year, because this is half, and get 0.5 million. Okay, so that is what is going to happen. Now, at that point, the cost model is what happened here. So you had your 20 million, depreciation thereof is 0.5 million, and that gives you 19.5 million. The transfer was made, and the value is now 21. So it's actually 21. So we are having 21 million, which means that there is a revaluation surplus here at this time. Okay, at this time that we are making. So a revaluation surplus that accrue here, we are going to go through and get a 1.5 million. The question is that why would this 1.5 million go? Of course, at this date, it will go to the OCI. Now, from here, it attains the value of a fair value, and therefore another subsequent fair value that is given is 1.6. Herein, you have 0.6 million, which at this time will now go to the P&L. Remember, there is no depreciation to be charged. The only depreciation for the entire year will now be this, with these figures going to the OCI, and also with this one going through to the P&L. All right, so it's very simple. It's as simple. You need to know that when it takes the fair value model, you don't depreciate it anymore. All right, so that is that. That is that. All right, there is another question here we need to go through and look at. It says that Comfort is a manufacturing entity and purchased a property for 1 million on January 1. Dates are key for its investment potential, meaning that they may try to use it as an item. The land element of the cost is believed to be 400,000, and the building is expected to have a useful life of 50 years. I said that at 1st December 2011, the local property indices suggest that the fair value of the land has risen to 1.1 million. If we are going to go through and use the cost model, so what we are going to do here is to find our depreciation. How do we do that? We have this thing to be 11 million with the land part for 1 million with the land part 400,000. Which means that land is not depreciated. Which means that we need to go through and find the depreciation of the building. Useful life, we are told, is 50 years. We need to use 50 years to find. Remember, it's January, and that one gives us 12,000. All right, so this one goes to P&L. If we now want to go on and get our carried amount, what we are going to do is to take the full 1 million, which is the land and the building together, less our 12,000, and we are going to get 988,000 into our SOFP. All right, that is it. Now, if we are going to go through and do the fair value model, what you should understand is that in the fair value model, this depreciation will never happen. All right, this depreciation will never happen. So what you are going to go through is that if the thing was 1 million, it has now moved to 1.1 million. So what you're going to go through is that you're going to have this 100,000 to your P&L as revaluation surplus. All right. Now this 1.1 will now be your SOFP. Keep it, no depreciation. So always check in your exam at the point where the asset become an IP, and do know that there will be no depreciation on it. It's very, very important. Know that. All right. So that is it under tangible non-current asset. When we meet again, we're going to go through and deal with the intangible aspect. So we will go through and do IAS 38 and follow through with impairments. Okay, impairment, NCA held for sale. All right. So God bless you. Make sure you watch the video consistently and go through the past questions to get yourself ready. I will see you in our lecture number 4.